Welcome everyone. Today we're going to do a deep dive into a very important topic, especially for all you first-time home buyers out there. How do you determine if you're financially ready to buy a home? Buying a home is a significant decision, and it's crucial to ensure that you're well prepared. So in our lesson today, in this video, I'm going to guide you through some key factors that you're going to need to consider when you're assessing your financial readiness. Number one, the first step we need to evaluate is your savings and your budget. We need to figure out, do you have enough money for a down payment, closing costs, and other related expenses? It's important to consider not only the initial cost, that down payment, that closing, but also the ongoing expenses over time, which are going to be your mortgage payments, tax, insurance, as well as the home maintenance, repairs, and upkeep. You want to review your budget in depth to determine that you can comfortably afford those additional expenses that may be different from when you were living in a home with family or you were renting an apartment or a small property. The next thing we need to do is evaluate your credit worthiness. We need to look at your credit score, your credit history, your debt to income ratio. This is what lenders use when determining your eligibility for a mortgage. So you got to check your credit. I'm not talking about Credit Karma, Credit Sesame, or one of those websites. The one I recommend is annualcreditreport.com. Annualcreditreport.com. It's the only completely free site where you can access your credit report once per year per bureau. Now, once you get that credit report, you want to make sure there's no errors on there. You want to make sure everything's accurate. Don't worry about paying extra to buy the credit score. Just make sure the information on there is accurate. We'll get to the credit scores when you get time to speak to a lender. The next thing that we need to discuss is your employment stability. Another critical factor when you're getting a mortgage is your stability of your job. So lenders prefer a job with a consistent long-term history, preferably with the same employer, but I've had clients get approved with as little as a few weeks or even an upcoming job they haven't started yet. So if you have an irregular job or self-employed situation, just speak with a lender to figure out what program is going to work for you and make sure that you show consistent earnings and profit over a long period of time. Next is we need to factor the debt to income ratio. The DTI, or debt to income, is the percentage of your monthly income that goes towards paying back your debt. So lenders have different guidelines for this depending on the loan program that you're qualifying for, but they use it to assess how you're going to pay your debt in addition to your current mortgage and how much money that you have available to do that. Ideally, this ratio should be below 43%, but there are programs like FHA and VA that go much, much higher than that. So in order to calculate your debt to income ratio, you'll divide your total monthly debt minimum payments by your gross monthly income. And that's the amount you ideally want it to be, below 43%. Check with your advisor on this because, again, there are programs that can go a lot higher and can still get you in. Lastly is educating yourself on the various mortgage options and affordability. There's a lot of different mortgage options out there, a lot of different programs for all different people, different walks of life, different financial situations. So research different mortgage types, get with a local advisor that understands and has experience to guide you, and if you need to, you can use an online calculator to estimate monthly payments, but I always recommend getting with a professional to figure that out because a lot of the time the online calculators are not going to be accurate based on the loan that you're qualifying for. So to wrap up our video here today, determining that financial readiness to buy a home, it does require careful consideration of your budget, savings, credit, employment stability, and your DTI, or debt to income. If we evaluate all these factors, you can gain that better understanding of your financial position. Then we can figure out, are you ready to buy a home? Are you financially in a position to buy a home? You want to consult with that mortgage advisor who's highly recommended to provide personalized guidance. The information that I'm giving you here today is just generic. So I do appreciate you watching and taking the time today. I hope you found value in this video and I hope it's been helpful to you. Don't forget, like and subscribe to the channel for more valuable tips and insights. And as always, if I can be assistance to you or someone that you know, reach out to me by call, text, or private message. I look forward to speaking with you soon. And again, thanks for watching. Take care now.